Okay, first of all, we are joined by a very dear friend of mine who worked with me on the Money Channel and on LBC when he was known as Charles Gibson. He's now Lord Ashbourne and is Director of Content Mining at Edison Research. And I'm sure he'll have a view on where the price of gold may go and whether history is indeed repeating itself. Charles, over to you.
Sarah, thank you very much indeed, and a very warm welcome to you all. And I hope you can see me all right. And I could say apologies for the change of name, but there was little I could do about that. Apologies also if you remember me as fresh-faced and youthful. I just, what can I say? It's just a lockdown affectation. So the name's changed, the looks changed, but most of what's underneath has remained, I think it'd be fair to say, pretty much the same. So I've been a gold and precious metals analyst since 1996. So I've got a bit of experience at it. And this is really just to give you, what my thoughts are at the moment. So I've got a little slideshow here that I will do my best. Hopefully you will be able to see this coming up very soon on your screens. So if you could just all confirm that you can see that, or someone can confirm that they see that, that would be great.
You can see it, Charles.
Fabulous. Thank you very much indeed. So I guess we all know where we are. And, the thesis of a lot of this is that what's happening at the moment, to my view, is very, very similar to what happened in the late, or throughout the 1970s, but in particular at the moment, the late 1970s. And I just want to try and ask the question about what that means in terms of where the gold price might go. Now, let's see if I can move this forward. That's the gold price. I don't think I need to dwell on that over the last 100 and a bit years. That's what it looks like. You can see that first spike in here between 73 and 83. That's the sort of period I'm talking about. And you obviously, what I'm asking is what is the similarity with that spike that we're now looking at between 2013 to 2023. Just before I get on to that, I think it's worth just saying, when you're looking at gold, often, and particularly if you're my generation, you joined the market in the late 1990s, you think of as gold as, perhaps a diversifier, perhaps an insurance policy, but not something you really necessarily buy for performance. And this actually is to contradict that. That way of thinking. If you look since 1967, in capital price terms, the gold price has actually outperformed the Dow Jones, and by a reasonable margin. So although you might want to think of it as a diversifier and as an insurance policy, actually it's one that has performed better than the thing that you're probably insuring against, in this case in the form of the Dow Jones. Now I know you'll get an income from the Dow Jones that you won't from the gold price. If you want to add that in, you'll probably find that the two roughly equal out. So in total return terms, they're actually very, very similar. The other thing that's probably, you can look at this in a different way, which is the Dow Jones divided by the gold price. And you can see at the moment, so you'll see in, when the graph is high, then gold is cheap and the Dow Jones is expensive. When the graph is low, then it's the reverse. Gold is expensive and the Dow Jones is cheap. You can see we're actually roughly in the middle. And if you want to look at a time-weighted average, we're actually the gold price looks a little bit cheap relative to the Dow Jones in those terms. So historically, it's been a very, very good performer if you want to look over the long term, as well as being a diversifier, and as Sarah said, a long-term store of value as well. Now, the thing I really want to look at is, as we move into this era of slightly higher interest rates, and what that might mean and what the parallel is with the 1970s. This is actually just a graph to compare risk and returns. And the other thing you can see, if you're thinking of gold against other commodities, it has a fantastic risk reward ratio. So you can see the gold point there. Has it been outperformed by vanadium? Yes, it has, in what I would call the gold bull market from January 20 2002 to the present. Uranium is there, but vanadium, in order to get that performance, you have to take much, much greater risk. All right, uranium has outperformed it, but apart from those two metals, gold has been a fantastic performer in risk and reward terms. Now, back to the parallels between today and the 1970s, and this is a graph of real interest rates against the gold price. And the two grey lines are the 1970s, and the two green lines are the 2000s, really the 2000s until the present. So June 2004 to June 2023. And what I really want you to look at is what happened in those ovals at the end of each of those gold bull runs. And what I want you to look at on the grey lines to the left of the chart are, you can see there's a huge amount of volatility in real interest rates. What happens is right over to the left-hand side of the chart, we're in the early 1970s or the early 2000s, and we've got the US in particular running twin deficits, and the Federal Reserve is reacting to this by putting up interest rates. It's trying to get on top of a burgeoning inflation problem. What it does is it actually pops an internal credit bubble. The economy goes into a recession, if not threatens a depression, and the Federal Reserve brings interest rates down to near zero or zero. Real interest rates go negative, and that's the point you can see for both lines, both the green and the grey lines, around about 0.49. But 49 is 49 months, so we're basically looking at 4 years and 1 month after the start of this chart. So that's the bottom of the depression. It corresponds to sort of February 1975, or it corresponds to about July 2008, when, the likes of Lehman Brothers were going down. And then what you see after that is the recovery. We try and get back to the erstwhile sort of status quo ante, positive real interest rates. So you can see the green line and the grey line, the dark green and dark grey, they come up to that 0 point. There's zero real interest rates. And then they trog along that for quite a while, actually, much longer in the case of the 2000s crisis, if I can put it that way, than in the 1970s. But then you get this attempt at normalization where real interest rates move positive. And you can see that on the far right of the graph, the green line. In the last few months, we've seen real interest rates go positive. We know that because federal funds rate 5.25%, and inflation, what now, 3.4 or something like that. So real interest rates. And I'm just contrasting then that green line with the grey line, and that's what that blue arrow is going across. I'm saying I want to compare that green line on the right to what happened in the equivalent period on the grey line when we came out in the 1970s. So I want to just look at exactly the same data in a different way. That is real interest rates on the x-axis, the gold price on the y-axis. Where are we now? This is in the current crisis, 2004 to 2024. Where are we? Well, we're at the point roughly marked by the arrow. Gold price a bit over 2,000, real interest rates about 2%. And, if you look at that graph, you think, well, there are not many ways that gold can stay at this level. You'd think it has to go down. But what I would say is, look what happened in the 1970s. And this is the equivalent graph. That is the last point that's arrowed there, where real interest rates were negative. The gold price was a bit over $300 an ounce. And you think, where does it go? Because you look at that graph, and again, you can't see any other way for that to go but the gold price moving downwards one way or another. And what actually happens, this is what happens. You see that this point here, that was the point that was arrowed in the last chart. And what actually happens is gold moves here as real interest rates go positive. First of all, the gold price goes up. And then when real interest rates go down, it goes way up. And actually gold completely rebases. What's interesting about these two best fit lines, the orange dotted line and the blue dotted line, excuse me, is that they have almost exactly the same gradient. The only difference between them is how far apart they are, which is a sure sign that the gold price is rebasing from one, if you like, way of thinking in terms of its value to another one. And you can either argue that the orange line is about $400 an ounce above the blue line, or you can argue that it's about 4 times higher. And what does that mean for where we are in the current market? Well, those green points are the ones you saw before for the current crisis. the solid black line at the bottom is the best fit line. And then what I call the midline, which is the light green line, that is $400 an ounce above above the black line. And then the solid gray line at the very top, that is 4.5 times higher than the solid black line. So when you see me, and you'll see me quoted sometimes as, where do I think the gold price could go? Well, if that comparison holds, then we could see where we are at the moment. Roughly, we could see it go out here, and then as real interest rates fall, could it get to 4,500? Yes, I think it can get to 4,500. There are many other ways of looking at it, but that is my central scenario when you're looking at real interest rates. And why real interest rates are not necessarily bad for the gold price. It's only when real interest rates reach 4%, so that would be the equivalent of having the Fed funds rate at about 7.5% now, that will kill the gold market. And 7.5%, it'll kill a lot of other things as well at the same time, but that is what killed the gold price in the late 1970s. There are lots of other things that are pushing gold higher at the moment. This is total US monetary base, so M0. The gray line at the bottom is what the total monetary base would have done if it had just grown through the crisis at the trend rate. The light green line above that is what happened after the crisis, the global financial crisis, when we had QE1, QE2, QE3, and then you see the attempt at tapering at the end. And then you'll remember in 2019, in response to stresses in the repo market, the Federal Reserve quietly said, well, actually, we're not going to do that tapering. So, the dark green line is then what I thought would happen when they made that announcement. I thought the monetary base would go sideways for a while before growing again. Then we had COVID, and what you can see is this huge increase there. All right, it came off. It's come off in the last year. That is 2021 and 2022 are the last 2 points on that upper gray line. What's it doing now, however? This is the monthly chart, and you can see the same peak in December 2021. Then it comes off to December 22. And what's it doing? The total monetary base is rising again. Why is that important? Because there's a fantastic correlation between the total US monetary base, which I always like to look at as it's either dollars in circulation or it's dollars in circulation and dollars that could be in circulation. And you would expect that to have a relationship with the gold price, given that gold is a real asset, and to all intents and purposes, the Federal Reserve can print as many dollars as it likes. So, back in the days of $35 an ounce, there was a mandated legal requirement to maintain the relationship between the two at 35 to 1. Now, I'm positing that there must be some sort of relationship, and actually the mathematics would suggest that the market would agree with that, and it thinks there is a relationship. You can see here, you can see that sort of what I'd call a false peak in 2012 with the gold price, and then it settled off into this sort of area, but still very strong in terms of the correlation. If you want to look at those two things, if you look at the green line there, that is the total US monetary base. If you look at the gray line, that is the gold price. And if you look at the light green line, that is what you would have predicted that the gold price should be based on its correlation with the total US monetary base as it would have been perceived in that year. And you can see not a perfect relationship, but not a bad relationship at all. If you divide one by the other, this then gives you a sort of a measure of how much speculative pressure is in the market. And you can see that peak in 1980, round about here. But you can see the 70s had two peaks. And one of the big questions is, well, what's happening here? Is that one peak? Is that two peak? And is that the trough? And if you go, if you look not at the total US monetary base, but if you look at currency in circulation, again, a very good correlation. You see it much more clearly. Two peaks in the 1970s, one peak in the 2000s. What does that mean in terms of where we go from here? Well, if you do the strict correlations and you say, right, where should the gold price be? You're going to come out with a figure of around about 2000. And that should then, and those are those three lines, three straight lines at the bottom on the far left. You're going to come out with a figure of about 2000. And could the gold price fall to those levels? Yes, it could. But if you impose the that speculative pressure, where does it go to? It goes to 3,300. So where we're sitting at 2,300 at the moment. Could the price go down to 2,000, 2,100, 1,900? Yes, it could. But equally, could it go up to 3,300? So my point is, I think that there's an asymmetric risk there, if you like. There's $1,000 to the upside that the gold price could go, and there's $300-400 to the downside. So I definitely think that this is to answer Sarah's question, is it an investment for now? Yes, it is. You're riding the cycle, no doubt about that. But that's what I think we like to do in investing, isn't it? Is it a store of value? Yes, it is. It is that as well. Just to remind people, those of you not distinguished enough to remember, a lot of the similar sort of things were going on in the late 1970s, and not just economically, but also politically. Just to name a few, you had the Iran crisis, you had the invasion of Afghanistan by the Soviet Union, the Middle East was in crisis, Africa was in crisis, Chrysler had been bailed out by the US government for the umpteenth time. So the parallels, in my opinion, are absolutely striking, and that's where I think we are in terms of our economic evolution, and that's why I think that gold can go much higher. And finally, I'll leave you with the quote that I think summarizes it, attributed to Mark Twain. Never know, he may even have said it, but history doesn't repeat itself, but it often rhymes. And I definitely reckon that we're in one of those points in the cycle where it's rhyming, and it's rhyming pretty heavily. So with that, Sarah, shall I come off my screen share and send it back over to you?
Yes, please. Thank you very much indeed for that. Unfortunately, we have run out of time in this section of the webinar with you, but I do want you to hang around until the end, and I'm going to bring you back in to summarize and lob some questions at you. So thank you very much, Lord Ashbourne. Really appreciate it.